started. Everything I'm sharing is educational purpose only, and whatever I share is just take it a grain of salt. It's my opinion only. Okay, so what you're looking at is the GDP versus where we are at today, the growth of the GDP. On the left side, you are looking at the GDP growth as of quarter three that this year is. You can see the GDP growth this year and this quarter 4.9% versus last quarter 2.1%. So some of you might be thinking, what makes it? Why all of a sudden GDP is going that high, and how that's going to be reflect to the market? So on the right side, what you are looking at consumption, like in consumer, people are still spending money. People have jobs. So when you have a job, of course you go and spend the money and just do whatever you need to do in order for you to take care of your daily needs, and also that that if price goes higher, people are able to afford the price while fighting that inflation battle and so on. Business also, you can see that investment slowly increasing. Housing is a good sign this quarter. It looks like on the housing side, they slowly is picking up. Last quarter, they say they are seeing a sign of housing market is increasing, and government spending also. I guess last quarter they saw little bit spent. So all this contributing, you can see government spending, housing, and the consumption. All three is the one main key areas where they see the growth, and hence GDP is for was last quarter 4.9%.
The housing question with the housing, is that new housing or is it just sale of houses?
It's everything combination. It's just
Oh,
entire index they're looking at.
gotcha.
Okay. Um. So was that ties with the market in each side on the bond market? In the bond market, you can see the 10 years treasury yield is going higher as expected. It's borrowing money from the government. The of course has to come with the price. That rate is from the government side was growing, but as you can see that when economy is doing well, GDP is also doing well. That might make Fed to stop pausing this rate, so that stop raising interest is one another pressure they might get, and hence if that happens, we'll see. Economics data, inflation, you can see inflation rates are coming down. If you compare what's where today, where we are at, comparing last year, it is it's 3 point. We are about close to around 4%, 3.89, where last year it was around over 5%, 5.8 somewhere. But the target is 2% rate, which we all know that that's what they're the Fed all wants to bring it down. And strong GDP, you saw the consumer spending money, so which is good for the economy. And then while that's been happening, then the signals, the market is getting the mixed signal right now, pullback. We know that since last year to this year, the growth Nasdaq tech, some of the tech went all-time high, and it was keep going higher, and it's time for them pull back. So we are seeing that slowly we are seeing some of the correction happening. Now officially that's last week, it looks like we are heading into correction zone. Um, I'll share with you a little bit more on that one later coming up, more data. So market perspective is earnings. We are seeing that earnings is as expected going higher, but same time what we are seeing, the November December historical data versus what happened on August and the September and October, which season we know that historically those 2 months is down, but I have some graph later, and we'll expand on that one. And the current correction for the normal is like, as I said, we are heading to that market correction. So what you're looking on the left side, S&P last month by month since 1945. If you look at January to December month, S&P return for every single month. That's the index you're looking at. And on the right side, you are looking at percent of time positive in each month since 1945. How many percent of times those months turn out to positive if you look at historical data. But here, as expected, you see on the left side, September, October, barely right there on the positive side. September is most of the time is negative, you can see, where October, barely. But on the right side, you can see that September, October is there. But the bigger sign is like on the November, December. Historically, it shows those 2 month market does well. Okay, but that doesn't mean that in a it will happen this time. And here next one, what you are looking at when we go through this correction, what happens after the corrections? S&P returns during and after corrections since 1971 until September 28 to December data. On the left side, you can see market correction. When market correction happens, following months, you can see that how it bounce back. So if you
Wow.
look at Nasdaq currently, we are Nasdaq. I have a chart later on that we are Nasdaq is about 10% down for the this year growth, where other markets you are going to see a chart that is still right there. But if we are heading to the correction zone, what you should be doing that but historically it shows when it bounce back strong in next 6 months. Okay,
But we only dropped how much now? 10%?
10%, about a 9-10% Nasdaq down.
So we could
Mm.
drop another 10%, is what you're
Yep,
saying.
yep.
Uh,
Well, it's
uh,
we just had a 2 weeks earnings, right? There is more earnings to go, and there is
right.
more bad news happening geopolitical side also. Correct?
Yep. Yep.
Um, so here, what you are looking at that week by week here, this last week Nasdaq, 2% it was down last week, where you can see it's still year to date Nasdaq is 20% up, where S&P pretty much 7% year to date, but it also same almost 2.5% S&P last week going down, and Dow year to date is bit negative. It's lost all of its gain
Mm.
down 2.1. And last week they it pretty much Nasdaq got 2.6% down. We know that Nasdaq has more room to go down. Typically, this is what we see when there is a correction happens. Tech Nasdaq is the one get hit most, right? So next week, what's gonna happen? I don't know, but we know that there is more earnings to come. But this chart, I wanted to just see you guys and take a look at it. And I'm sure many of you are a lot more technical than this. But if you're looking at this chart, look at that where SPX, where we are at, is barely staying around 200 days moving days average there. Can it go down more? 1 year. I was looking at 1 year. So those who is thinking, where is the opportunity and where if you want to short, if you want to go the other way, look at year to date. Nvidia over 200% growth. Microsoft 42%. So some
Wow.
of them are like really still is growth well, but
Wait a minute.
there
The Google 30%, is that after that big drop? of
Yeah. Yeah,
19%.
this is
They're still
last
up
by
30% for the year.
yeah, Google 125 something still. Google is
Mhm.
still on the gain.
Better than Apple. Unbelievable.
Hmm. So yeah, if you look at it in 1 year, which other going
Look at
to
Tesla.
it might go down more and looking for
Uh-huh.
opportunities. That's what I thought that was a good heat map to take a look at it and then and decide.
That's it for this episode, folks. Thank you for listening. And if it was helpful to you, please click the like button and follow us so that you can listen to more of our podcast. You can also visit us at urbanhood.org to learn more about our other programs. We hope you'll check in with us again. And until then, keep learning and do whatever it takes to reach financial freedom and follow your dreams.